Looking at Taste Holdings out with interim results today, a flat performance on the headline earnings per share line. There's one thing I just can't get over with Taste, and that is we're looking at Scooter's Pizza in that fold, Maxi's fast food, and then this NWJ jewelry component. Can you just take me through the rationale for holding this jewelry element in Taste Holdings?
Yes, the CEO, Carla Gonzaga, often comments that Taste Holdings is basically a franchise operator. They are masters in organizing the marketing, the advertising, and the underlying administration of a multi-platform franchise operation. And he claims, be it in fast food or in healthcare or in jewelry or in retail, he could do franchising in virtually any segment. The thing is that investors like to invest in a company they understand, in a sector or an industry they can easily rationalize and value. You know, Taste Holdings is an oddity. It's got fast food, as you say, and jewelry. So should it be in retail? Should it be in food? So I think investors to date have held back the performance of Taste purely because they don't understand the underlying model. But the company believes its franchise model going forward in being a brand and franchise manager is the right way. But as we saw in the results, the consumers is having a tough time, trading down, spending less money on jewelry, and trading down, particularly on the fast food side.
Do you believe that this model will work?
I think we've seen in the last few months that the underlying Taste share price has moved up quite dramatically. You could have bought this share at about 40 cents about 3 or 4 months ago. It got to a high recently of the mid-70s. I think as the market begins to understand the underlying platform we operate from, and the fact that as a country we are spending more on fast food and on disposable, let's say, trinkets like jewelry, you know, their affordable options should hopefully reach a wider marketplace. Whether the underlying investment community will actually buy into this, I have no idea, but the underlying Taste model seems to be working for them.
Robex coming out with a trading update today, and it looks as though heated competition in that arena putting pressure on margins.
Yes, a surprising update when I read it this morning. Basically, Sandrol, one of the few government agencies which actually has money to spend on infrastructure, had a major investment conference a few weeks ago, indicating that the spend going forward on roads will be quite substantial. And as such, many of the building contractors involved in roads run up quite sharply. You could have bought Robex again a few weeks ago for 20 Rand. It moved up to 25. So I think the trading update indicating that competition was quite tough, I think caught a few people unawares because it wasn't in line with the indications that, let's say, the market was expecting from certain roads companies. But as we've mentioned in the past in the show, many of the larger contractors are moving into this space, margins are being squeezed, and they're all looking for work. And as such, profits are coming down. And Robex, sadly, has been squeezed.
Adcorp out with results, interim results. Yesterday I had Richard Pike, the CEO, in the studio. And if you look at that headline earnings per share line, a relatively flat performance, normalized earnings per share down 6%, but a very good improvement on gearing. At the end of August 2009, gearing was at a 46% level, down now to just 10%. So a strong improvement on balance sheet.
Yes, I recently spoke to the company ahead of results. And I think following the trend from the last sort of results that came out, you know, the underlying thing that Adcorp is seeing in the marketplace is that white-collar workers, the demand for white-collar is actually beginning to increase. The underlying blue-collar and specialist agencies, like nursing, for example, continues to be quite lackluster. But there is a very gentle improvement in the employment market in this country. And it is slowly being seen amongst Adcorp and Advotech and other companies in that sector. But in Adcorp's case, the key thing is de-gearing. It was under severe financial distress a couple of years ago. Gearing has fallen very, very sharply to the point where perhaps in a year or two it will be completely ungeared. The company generates enormous amounts of cash, pays fat dividends. I think
cash generated by operations up 199%. As you said, a stellar performance on that front.
Yes, and I think going forward, that's the key thing to the employment sector, and particularly companies like Advotech and Adcorp. They generate vast amount of cash. They can't really spend it. So what they do is they give it back to shareholders. I'm sure Etienne would concur that these counters pay very, very generous dividends and are very consistent in their cash flow going forward. You know, Adcorp's been a favourite of mine for quite some time. And I think on a de-geared basis, with the economy beginning to pick up and the demand for more employment, Adcorp at about 28 Rand is a counter worth looking at.
Just very quickly, they did make a comment about nursing and advertising recruitment, that those two arenas were under pressure. Is that a significant part of their business?
Not really. It's the recruitment side is quite meaningful in their lives. We have some very, very large businesses. The largest one is supplying staff into Eskom. which is like a 600 million rand a year business, generates about a quarter of their profits. That's doing quite well. Whilst recruitment advertising is important, there are certain other areas of a business which are mitigating the worst of the effects of the recession in the economy. So Adcoop, in theory, has a fairly balanced portfolio to grow going forward.
Anthony, thank you very much for your time. Enjoy your evening in Cape Town. Anthony Clark, Vunani Securities. Still in studio, Etienne Nel, BJM. It's Thursday. Any groundbreaking news that we can look forward to Friday that's going to move the markets one way or another?
Bronwyn, nothing that I can see in the crystal ball offhand. Suffice to say, I think at current levels the market is feeling very, very toppish, very uncertain, and probably not go far wrong if you took some cash off the table and put it in for us for a rainy day.
Let's talk specifics. Naspers, 361 Rand 11, closing today up 1% at the top of the top 40, as I said earlier. Do you take cash out of this counter now? Take your profits? Considering you are very favourable to Naspers.
Considering we've been calling this thing since 260 Rand a share, so it's about $100 a share in it since its recent lows. Reason for it running is basically Tencent is just shooting the lights out, and the IPO of Mail.ru in Russia is going dramatically well, in so much as the guys are thinking of moving the roadshow, cutting it short, simply because they've pretty much placed the entire listing. So just so much good news in the stock, and I think you probably end up shorting this thing at your peril.
Shorting it at your peril.
Yes.
Telkom today is going to unveil its long-awaited mobile strategy. Could this be the company's saving grace?
Bronwyn, I'm not so sure. I think Cell C have been struggling at this for 10 years. Telkom, Johnny come lately. I think management should maybe just close the doors and sell the copper. And the copper in the ground is worth more than that in market cap. So
that's a relatively blunt opinion you're expressing on Telkom. Let's move on quickly from these levels. If there was one stock in the top 40 that at these levels you still would buy, what would it be?
Not one.
Even the resources?
Even the resources. You need to keep in mind that the resources are very geared to the Rand. Her Rand is incredibly strong. To put it in perspective, the all-share index returned in US dollar terms 18% year to date, of which half has come from currency movement alone. So the market's up only 8% in Rand terms, but in dollar terms, we're shooting the lights out.